one standard deviation below mark, which means that today from an equity attractiveness standpoint, the market is fairly attractive from an earnings yield bond yield standpoint. So I think I'll break it down into, at least from an equity market standpoint, I will try and break it down into 2-3 key areas. Generally speaking itself, I think it's good to think about equities in Indian context. A lot of people try and comparing it with other emerging markets to ascertain whether Indian markets is relatively more attractive, less attractive. So these are the two cuts in terms of valuations. You will see that in the bottom chart there are these three charts where we talk about valuations in the historical context, and these are all 10-year histories. There is no reason why you should only take 10-year, or you should not take 15-year, or you should not take 5 years. 10-year, at least in today's context, seems relatively okay, because you are taking 5 years of pre-COVID environment, and you are taking 5 years of a post-COVID world, which was a very bullish kind of a world that we saw. But no, I don't want to run through that entire deck, because two reasons. One, like I mentioned, a lot of things have changed, and this presentation is a bit old in that context. So a lot of things may not be relevant, or some of the data points might have changed substantially for me to kind of refer to it. But at the same time, what I will try and do is maybe refer to some points where we are referring to more long-term things. Maybe I will try and refer to some of those charts there. But for the shorter term, I think things have changed very substantially, particularly in this month. Difficult for markets also, and so maybe I will try and spend some time on this month itself, and what has changed, and how are we kind of seeing the change. And the only issue is he mentioned that we can decode it and give you direction, but we are also confused. So we are we are also very confused about how things are. But what I will try and do is I will try and give what we are reading, what we are seeing, and what opinions we are forming. A lot of it is of course subject to change as things move along, and I will try and give you some sense around how we are seeing it, and every day for us is also bringing out new facets of this overall event risk that is playing out. So I think I'll break it down into, at least from an equity market standpoint, I will try and break it down into 2-3 key areas, which is generally speaking itself, I think it's good to think about equities from 3 or 4 broad cuts, and I will try and talk about it in the same manner. Generally, when we do asset allocation, we also think about equities from that standpoint. We look at 4 key aspects of equity to ascertain whether how equities are, and whether they are attractive, not attractive, and how should one think about it. First aspect is, of course, most of you would be aware, valuations are very important. Valuations gives you a perspective about the attractiveness of equity as an asset class, and this is irrespective of where you are today. Right? You are trying to compare today with how we have seen the past, and irrespective of today's events, it puts today's valuations in the context of how historically things have been. So that's one area which is always very important and remains important. The second area that we look at is sentiments. Sentiments is important because valuations, while they are important, sentiments capture to some extent how the markets are thinking in the very recent past, so to speak. And here we try and decipher sentiments in a way which is a little bit opposite of what the word itself might connotate. So sometimes sentiments suggest that you are looking for, if it is a positive sentiment, you try and act positively, and if it is a negative sentiment, you try and kind of act a little negatively. But here what I mean by sentiments is trying to understand what excesses are happened or are happening in the market. So try and be a little bit contrarian also in it. So in a way, it is not sentiments which means momentum. It's sentiment which suggests that if you are at some extreme level of sentiment, either of bullishness or bearishness, then that is a point for you to act. In between, of course, we don't, many other things matter a lot more. than sentiments per se. But at extremes, sentiments can be very useful tool, because at extremes, sentiments tend to reverse. If you are extremely bullish, more likely than not, some bad news can trigger a big fall in market. Similarly, if you are in a very bearish state, I mean, it will take something very small for you to start turning bullish overall. So generally that helps us. So we look at sentiments also for equity markets to understand where are we in that bullishness bearishness cycle. So that is the second area which is important. The third area which is important is overall, I would think, the liquidity flows. That also matters a lot. And generally speaking, liquidity can be seen in two contexts. One is, of course, in the context of what institutional participants, retail participants are all doing in the marketplace within institutions. In India, of course, we are very used to seeing this institutional flows from an FII and a standpoint and a DII standpoint. But the other bigger area of liquidity which is important, particularly when you are dealing with risk asset classes like equity, is the overall money supply growth. I mean, overall, how is the overall liquidity environment globally and domestically panning out? So whether you look at whether money supply is narrowing, and money supply can again be of two counts. One is the base money supply growth, the other is the broad money supply growth, right? So what are the central banks doing? And post that, how is the overall liquidity in the system from a bank lending standpoint, how is it doing? That gives you some sense of liquidity at an overall aggregate level, how it is panning out, and that has implications in terms of how risk on asset classes behave. So that's the third area which is, I think, critical. And the fourth area which is important is, of course, overall macro environment. I think macro, like you all understand, encapsulates a lot of aspects. Macro is not just about GDP and inflation. It can be many other things. In particular, from a market context, macro is probably the least of the variables that can be correlated to markets, because markets is its own animal. And hence, if you try and correlate markets to any macro parameter, you will get very unsatisfactory outcomes. Having said that, it is still a very important animal to understand, because it drives a lot of variables which market wants. Like for instance, earnings has a lot of correlations to how the macro is panning out, particularly how the different sectors can behave. So that macroeconomic cycle and that backdrop, to that extent, start becoming relevant. So I will try and kind of talk about these four aspects, and then we can I can kind of take your questions and understand if I have to kind of delve deeper into any of these. So from a valuation standpoint, I think this is the most easy to do, because this is a very mathematical number. I mean, there is no art behind it. I mean, there is an art when we talk about individual stocks, but at an aggregate market level, the only thing you can do is to look at what aggregate valuations the market is trading today at, and how does it compare. You can compare it to 2-3 things. You can either compare it to how historically the valuations have been for our markets. And now again, when I say history, again it becomes difficult to say which history are you talking about. Are you talking about a 5-year history? Are you talking about a 10-year history? Are you talking about a long-term 15-year history? So that's one thing you can ask. The second area you can ask is, how does the valuation compare versus, say, the rest of the world? So in Indian context, a lot of people try and comparing it with other emerging markets to ascertain whether Indian markets is relatively more attractive, less attractive. So these are the two cuts in terms of valuations. Again, the third cut which can potentially happen, and we do that as well, is to figure out what valuation parameter itself to use. Do you want a price to earnings ratio? Do you want to price to book? Do you want to see earnings yield to bond yield ratio? So these kind of valuation, these are the different parameters that you can use to ascertain whether what the market valuations are, right? So maybe I'll just quickly take you there. The numbers are not here really very relevant. Numbers have changed, but it's useful to give you some context in terms of how we think about market valuations. Yeah, so generally speaking, I think you will see that in the bottom chart, there are these 3 charts where we talk about valuations in the historical context, and these are all 10-year histories. There is no reason why you should only take 10-year, or you should not take 15-year, or you should not take 5 years. But we generally believe that 10-year, at least in today's context, seems relatively okay, because you are taking 5 years of pre-COVID environment, which was relatively, I would say, a muted environment, and you are taking 5 years of a post-COVID world, which was a very bullish kind of a world that we saw. So in a way, it kind of averages those two out. So we are kind of taking a 10-year number here and trying to ascertain how the market valuations today are relative to those 10 years. So this is of course a dated chart, but what I can say today is that despite the correction that we have seen in markets, we are not above, we are still at or slightly above some of the 10-year numbers when you look at market multiples. So in case of mid and small, I think we are still probably higher, a little bit higher in case of mid. Small caps have corrected a little bit more. But having said that, large caps are the only place where we have come back to average levels in terms of valuations. So that's an important point to remember. So large caps is where we are probably, after this correction that we have seen, we are back to those long period average multiples. So here the long period average is showing at around 19x, and we are today at 19x. I mean, if today's earnings estimates for FY27 were to pan out, so FY27 today would be about, I think at consensus numbers for Nifty should be about 1250 rupees of EPS. Today market would be at maybe 23,200, 300. So if you do that math, you will get to this 19x kind of a number from a forward multiple standpoint. So this, like I said, this is the most easy to compute number, and a lot of people of course use this number. So today we are at that point in time where you can say we are at long period average. That is not to say that markets don't go below long period average. That is not to say that we should go back to one standard deviations, which we have largely been in for the last, I would say, post-COVID environment. We have largely been one standard deviation above the average. So I'm not making either of these two comments. The only comment that I am making here is that we are at long period average, which suggests to us that markets, if everything is under normal circumstances, we are fairly valued today, at least on the large cap side. The other way to think about valuations is in the context of, which is not the case for mid and small, they are a little bit more elevated even today, I would imagine. The other way to look about market valuations would be this, the left hand side chart, which tries to compare market valuations to the emerging markets pack. Because this is more relevant from an FII standpoint, but because FIIs are a very important animal in Indian markets, we also look at it from that standpoint to ascertain how they are looking within the emerging market basket, how are they seeing India as a country. So on an average, we have traded at around 65% premium to the rest of the emerging markets. So on an average, if for instance the rest of the emerging markets trade at 12 times price to earnings, we would be trading at 20 times price to earnings. So that 12 to 20 distance is that 65% premium that we have normally traded at. Today, what has happened over the course of the last 1.5 odd years is that the rest of the emerging markets have substantially re-rated. They have gone up very sharply, whereas Indian markets have remained stagnant for the last 1.5 years. So September 24 was the peak that our market made. Since then, we have only been on a downward correction. I mean, we have gone up and down a bit, but generally speaking, we have been in almost a 1.5 year kind of a time horizon where we have not given any returns. So what has happened, because the rest of the markets went up by almost 50% over this period, rest of the emerging markets, today this premium number, which is on an average 65%, has come down to about 35%. So we are today, if you look at it, rest of the emerging markets today trades at almost a 17x kind of a number. And then we are, like we said, about 19x or 20x from a forward standpoint. So we are close to that, I would say, a 35% premium number to the rest of the emerging markets. So that makes it, for probably the very first time in the last 10 or 15 years, that we have come to this level of premium versus rest of the emerging markets. This has not happened, I think, for a very, very long time. I think briefly, I think during COVID it happened. But otherwise, generally speaking, we have always been a market which has traded substantially at the 65% average or a higher number also. So most of post-COVID, we spent above the 65% number in terms of premium. Today, we have come down. So on a relative scale to the rest of the emerging markets, we are at a premium which is lower, and relative to our own history, we have come back to average levels. So that makes this market, I would say, a fair to slightly attractive market. The third way that you can look at the same number is from an earnings yield bond yield ratio standpoint. And this is again a relative valuation measure between equity and debt. I think this is actually, in Indian context, it works very well. Generally, in many of our asset allocation frameworks from a valuation standpoint, we find this to be one of the better valuation measures. On this count, if you look at how we have fared, I'm not sure whether I have it included here. Sorry. Yeah, this is the EY/BY ratio. So again, this is a dated chart, but what you would find here is that we have come on this chart, we have come to a one standard deviation below mark, which means that today from an equity attractiveness standpoint, the market is fairly attractive from an earnings yield bond yield standpoint. There's also obviously the context is that even the bond yields have kind of gone up in this period and equity markets have come down, and that has meant that actually bond yields going up is also not very favorable, but net because of the correction that we have seen in the markets overall, I think this EY/BY ratio today has become reasonably favorable. So what I talked about P ratios coming to long period average, this number has gone to almost one standard deviation below, which makes it, so on two counts it makes it relatively attractive on valuations. One is the premium that we trade to rest of the emerging markets and earnings yield bond yield. On these two parameters we may be considered today as, at least from a large cap standpoint, an reasonably attractive market. From a price to earnings standpoint, we can say we are fairly valued kind of a market. So that's where I would put the valuation part of this. Now we have to try and marry that with the, I would say, what I talked about from a sentiment standpoint, because marrying just valuations in themselves are not always very conclusive. They are useful, but they may not suggest how the things are, how extreme or how on either side, extreme bullishness, bearishness. I think that the best gauge for that is looking at some sentiment factors. So there are again multiple ways that you can look at sentiments, right? The most popular way to look at it is, I think, what we do, there are two ways we look at it. We look at market breadth. If market is very broad in terms of its performance, we generally say that the market is a very bullish market. And the breadth can again be ascertained in two ways. It can be either be through price movements, which means a large number of stocks have kind of done well, and that gives you that the price optimism is very high in the market. The other way to see the optimism levels is the volume participation. So if a large number of stocks are seeing a lot of high volumes being traded of stocks, that gives you also the kind of optimism that is there in the market. So generally, if the breadth is high on both price factors and on volume factors, we call that market to be a relatively bullish kind of a market. And like I initially said, the sentiments that we try and track is to ascertain a contrarian position to it. If we say that there is extreme bullishness in the market, then we should be more cautious. And that's exactly how we run, at least in many of our asset allocation products. That's the approach that we will take, which is why you would find that in our multi-asset allocation fund or in BAF, the peak of these ratios were pretty much in September of 2024. Whether you look at price earnings, the price optimism or the breadth of the price or the breadth of the volumes traded in the marketplace. There were other parameters also which we track, which is like the number of IPOs that happen. There are many things which you can track to ascertain the optimism in the marketplace. So that was the lowest of our allocation into equity in both of these products. So at that point in time, if you look at September 24, October 24, both our multi-asset allocation product, we had reached about 45% allocation at that point in time in our multi-asset. And similarly, if you look at our BAF, I think we were around 49% allocation to equities, which was below 50. Those were the bottoms in terms of our asset allocation into these products, because while, like I said, we do give a lot of respect to valuations, but if sentiments become too extreme, you have to respect that. If valuations are as it is on the expensive side and sentiments are super bullish, you need to be a lot more cautious, which is why at that point in time we were very, very cautious. I think in that entire second half of 24, we were running very low equity allocations across all our products, because we did feel that the markets were very overheated. The price breadth in the market was very high. The volume breadth was very high. The volumes traded of stocks, I will show you some charts on that also. I think we have some charts. These are the price charts and the breadth of the price, and this is the breadth of the volume. So you will find that here the top 100 stocks as a share of the overall market was one of its lowest, right? Which means that the rest of the markets were seeing volumes which were way higher than what was normally the case. This is again this is a longer history, but even if you look at a 10-year history from say here to here, you would find that this is probably pretty much the lowest, and this the other lowest point was in around 2018, which again after that you saw a broad market. After a lot of optimism, it cooled off very substantially. To the 2018 to 20 period, you did see that this is the concentration of the increasing of the top 100 stocks in terms of value traded. So this was the period when again large caps did well, mid and small did not do well, and we are again reached that same point in terms of the this thing. Now it has gone up a bit. I mean, this is a bit dated chart, but if you look at the chart now, in the last few months, this number is going up a little bit, which means that there is some concentration returning back to markets, which means some of the optimism that we saw on the sentiment side is getting a bit corrected. So, but generally speaking, it is still a market. When I see it from a historical 10-year perspective, it is still a overheated market, which means there is still some room for this market to correct, particularly from the breadth standpoint. I mean, it does not mean that Nifty may not give you return. Nifty may still give you return, but it is possible that a mid cap or a small cap index might give you lower returns than the Nifty returns per se for some more time to come. So that's the breadth indicator. So this is generally the comment around sentiments. The third thing which we look at, like I mentioned, is the overall liquidity. Because liquidity, and like I mentioned, I'm not talking about liquidity whether FII is selling, DII is buying. That is always bound to happen. I mean, if there is a seller in the market, someone has to be a buyer. Either the promoter has to sell for us to buy, or the FII has to sell for DII to buy, or the retail has to sell for us to buy. So it has to be market overall volumes will be, it will be obviously be equal. The way that we think about liquidity is how is the overall money supply growth panning out. Whether it's base money supply, whether it's broad money supply, how are those parameters behaving? Generally speaking, whenever we have found central bank balance sheets expanding, or we have seen overall money supply growth as strong, they are generally considered as favorable for risk on asset classes like equities. And similarly, when they are contracting and they are narrowing, they are headwind to equity market performance. And today, we have seen, at least in the last 1.5 to 2 years period, you have seen this overall balance sheet starting to kind of become narrower, and the growth has kind of moderated across the board. If you look at money supply growth in US, if you look at global money supply growth, it's becoming a lot more modest. So that's been a bit of a headwind to the market overall if you look at it. So that's on the liquidity piece, which is also not, I would say, extremely favorable, which has kind of become which had become a bit of a headwind. Now it's probably back in the neutral zone, I would say. Particularly for the Indian market context, we are starting to see money supply growth start to slowly inch up, particularly the broad money supply, the M3 growth. So this is something which we try and do, which is to look at how the money supply growth versus market returns have panning out. Of course, there is no direct correlation between the two, but it gives you some sense that if money supply growth is meaningfully lagging market returns, then it is likely that over time it will get neutralized. It will start to get mean reversed. So that is what we try and look at. So this is on the money supply bit. And last thing is which I talked about, which is extremely important, is the overall macro. And in the macro context, I think earnings is of course a very important variable. The overall macro itself is important. On the overall macro, I think there are 2-3 points which I would quickly make before coming to the earnings part of it. I think for Indian markets, generally speaking, I think one aspect which has always been very important has been, more than even the GDP growth number, more than the inflation number, generally what has been, at least from a market standpoint, very critical has been the balance of payment positions, which is the overall our external account balance. And I think one of the key features, I would say, of 2025 and even 2026 to a large extent has been that we have had some bit of balance of payment challenges, and a lot of it is emanated from the capital account side, which is very surprising. Traditionally in India, we have always been very good with capital accounts. Our problem has always been only on the current account side. We have been a current account deficit, but capital account surplus country. In the last 2 years, because of the valuations that I spoke about, Indian markets were in a very expensive market zone. So we had seen on both counts, which is FIIs were pulling out money, and we also saw FDI money getting pulled out, which means the FDIs were redeeming capital. So there was a lot of redemption on the FDI side, and which is why you would see that even our currency kind of became significantly weak. I mean, most people say that in a situation where we are running such low levels of inflation, ideally our currency should have appreciated, right? We are seeing situation where US market inflation and our market inflations are actually equal, or many cases we are actually lower. Whereas historically we have always been a very high inflation country versus US, and hence the currency used to depreciate. But in the last 1.5 to 2 years, despite inflation differential narrowing, despite inflation being favorable for us, currency has depreciated, and that's largely a reflection of the fact that because market valuations were very expensive, lot of this gross FDI flows that used to get offset by the net FDI redemptions. I mean the FDI redemptions, and hence the net FDI number became very small for us. I mean, it almost reached a negative number for us, and this is a very rare occurrence for us. We have always been a $40 billion, 30, 40, $50 billion FDI country, and that got totally wiped out because you would have seen so many foreign MNC companies selling 25% stake, 50% stake in India, pulling out all the money. So that was a big hit to Indian, I would say, BOP position, and that also got reflected in our currency. And that also drove some of the weakness that you saw in the equity markets, because currency also plays a role. If currency weakens, generally FIs tend to act negatively to that. So that's on the external account. I think the other important event, which I think another important variable which I think we track very closely, is this capex growth number from a macro standpoint. Because in case of India today, most people agree to the fact that as a country we are in a situation where for a lasting improvement in consumption cycle, we need the investment cycle to revive. And this is what I think even the government has been focused on. In the last few years, you would have seen government spending a lot in terms of their capex. The capex growth of the government was exceptionally high in the post-COVID environment. We were in one of the, I would say, few periods in time when we were growing at 20% plus the capex growth numbers. Partly a reflection that our nominal growth itself was very strong. I mean, the government revenues were growing very solidly, but they also invested a lot more in capex, and that drove a very strong capex cycle for us. And that got reflected also, if you see, in a lot of the capex heavy stocks doing exceptionally well post-COVID. So if you look at that entire rally that you saw 2021, 22, 23, a lot of it was driven by this industrial companies, capex heavy road infra companies, because the government was spending a lot. Now in the last 1.5 to 2 years, that has also got a bit challenged, partly because of the fact that the government revenue itself is growing much slower. Our nominal growth has shrunk from double digits to now high single digits, and that has implications for the government revenue growth. And they have also curtailed a bit on the capex side. They are doing a little bit more of I would say consumption related spendings. So on both these counts, this is a parameter which has got hit, and this has happened at a time when private corporate capex just started to kind of improve. So if it had fully kind of improved, you could have said that there has been a smooth transition from government capex spend to the private capex. But private capex was just about improving, household capex, the real estate cycle was just about improving, and this has slowed. So for us, this becomes extremely important that these two engines now has to fire for us, which is either the real estate cycle has to do well, or the private sector capex, which has been dead for almost 10-15 years. It has seen some improvement in the last 2 years, should continue to do well. So if these two things happen, then even if with a relatively more modest government capex, we can still survive what I can call a big a cyclical downturn. Right now we are not building in a big cyclical downturn, but that is a big risk that you need to keep in mind. And for us, this capex cycle is the biggest number to look at from a cyclical downturn standpoint. If the capex growth does not happen, then that has implications not just for the overall growth numbers, it has even implications for the consumption numbers, because this is where the employment is going to get generated for us in times to come. And this was the overall, I think, earnings cut numbers. I think over time we have seen that 26 and 27 numbers earnings got meaningfully shaved off. The good news is for the last 2-3 quarters there has been no meaningful cut in earnings. A lot of this happened somewhere around the second quarter of 2025 to the to around the first quarter of 2026. The last two quarters, which is 2Q and 3Q of FY26, has seen very limited earnings cut. So this appears to have formed a base, but now the new risk which has obviously come, and I will talk some bit about that as well, is the issue around fuel prices and what it does to earnings. Of course, a very high commodity price environment, a very high energy price environment, and in fact a non-availability of energy itself can be a big risk, at least to the first quarter numbers, to the current going on quarter, which is fourth quarter, and the next quarter. So a lot of it depends on how this energy crisis unfolds, how long this sustains, and hence will have some implications on that. So so broadly I think these are the issues. So that takes me to the conclusion slide, which here I'm kind of just try to encapsulate some of what we do, but these numbers, because they are dated, I don't want you to focus on the numbers, but broadly we want to look at overall equity markets in these 3-4 key areas, which is valuation, sentiments, liquidity, macro. Currently on valuations we are relatively okay, at least for the large cap bucket. On sentiments, the bullishness has kind of become a lot less prominent, but it needs to go a little bit more, which means I would still bet that markets might remain a little bit top heavy, little bit more focused on, concentrated towards few stocks, as opposed to being a broad market performance. Liquidity, I think, is it's anybody's guess, but my guess is that liquidity, we are kind of bottomed out and we are probably looking okay there. And the macro again is something which those 2-3 areas is where we need to focus on. Now with valuations coming down, I would imagine we might even start seeing some kind of an FDI, net FDI numbers start looking good. Even the gross FPI numbers might start looking good, provided of course this does not escalate any further. So to my mind, there are two scenarios which can be built from this current macro geopolitical risk that has come up. We either believe the camp, that if we be in the camp which says that this is a short-term 3-month kind of a situation, and post that things kind of settle down, and which means that the hit to earnings is only for 2 or 3 or maybe at max 4 quarters. And in that scenario, given where India is positioned from a global backdrop, we are at valuations that we are today, I think it is reasonable to expect that our large cap stocks will do fairly well in that environment, because FPI will come back again, and FIS, when they come back, they will largely be restricted to the top stocks in the country. So it would be fair to say that the large cap should do reasonably okay. The second scenario, which is a relatively more high risk scenario, is where the situation continues for a more prolonged period and it leads to actual concerns on demand destruction, it leads to concerns on sentiments turning adverse, and a potential recession risk, particularly in the developed markets like US. And if that environment plays off, then of course all bets are off. Then that's a situation where you might see even further, I would say 10-15% correction in Indian markets. So these are the two probable scenarios. I would still, in my judgment, stick to scenario 1 getting played out, which means I would still want to keep slowly increasing my equity market exposure. At least in these products, we are increasing our equity market exposure, assuming that this is a shorter term kind of a scenario, and at least for the large caps, it's a good entry point to start getting added on. But we are also closely tracking these developments, and if the risks of demand destruction and risks of recession becomes much more, then then clearly you might have a much more, and given where our markets are, which is that our markets are, like I said, we are relatively on the more expensive side versus history. If you look at the broader market, if I look at NSE 500, if I look at mid caps, small caps, relative to history, we are still a lot more expensive. So given that we are from an expensive standpoint, we can become cheap in a recession environment. That will leave a lot of downside still left in the market if that second scenario plays out. So that's broadly what I would want to kind of talk about.